mean for monetary policy? Let me try and answer. Over the last 1.5 years, monetary policy actions broadly included compression of excess liquidity in the system, increase in policy repo rate by 250 basis points, and change in policy stance to withdrawal of accommodation to keep inflation expectations anchored and break the stickiness of core inflation. Complementing these measures were proactive supply-side interventions by the government to improve domestic availability of key food items and reduce input costs. Consequently, headline inflation moderated to 4.6% in the first quarter of the current financial year, that is from April, May and June of the current financial year 23-24, as compared to 7.3% in the first quarter of last year. So last year in the first quarter it was 7.3%. This year in the first quarter the headline inflation moderated to 4.6%. A significant easing of inflation pressures from its exceptionally high level in July and August is expected to materialize in September as the impact of fleeting food price shocks wane. Further, underlying inflation pressures are also moderating while the impact of past monetary policy actions is still unfolding. Even so, indications are that throughout much of the third quarter of the current financial year, food inflation pressures may not see much easing, or rather may not see sustained easing. External factors like energy prices and financial market conditions continue to be volatile. All these call for careful monitoring of the incoming data and the outlook. That is, we have to monitor not only the incoming data but also the build-up of the future, the outlook, to clearly delineate the durable components of price shocks from its transitory elements. Monetary policy has to be in absolute readiness to take appropriate and timely action to prevent any spillovers from food and fuel price shocks to underlying inflation trends and risks to anchoring of inflation expectations. These are non-negotiable necessities. I would now like to turn to liquidity.